Welcome to today's explainer. Look, if you're stepping into the real estate market for the very first time, you already know buying a home is incredibly exciting. I mean, you get to browse the listings, hit up open houses, and really start imagining your new life. But let's be totally honest here. It can also be incredibly stressful, especially when you start looking at the math and suddenly feel like you need an accounting degree just to figure it out. Well, today, we're going to completely demystify the process of finding your true home buying comfort zone. We're taking you from a beginner to a confident buyer who knows exactly what fits their budget.
So before you even look at a single property, this is the absolute crucial question you have to ask yourself. How much house can I actually afford? It sounds super simple, right? But so many first-time buyers fall right into a dangerous trap. They focus entirely on the maximum amount a bank is willing to lend them. They get this piece of paper saying they're approved for, say, $500,000, and boom, they immediately start looking at $500,000 homes. But as you're going to see, that maximum limit is a ceiling. It is definitely not a target.
Okay, let's dive into this, because this right here is honestly the biggest myth in real estate. There is a massive difference between what you qualify for and what you can comfortably afford. When a lender qualifies you, they're basically just doing risk math. They look at your income, your debts, your credit profile, all to determine the absolute maximum they will risk lending you. That number protects the bank, but comfortable affordability, well, that protects you. That's entirely personal. The bank's math does not care if you love to travel, or if you support family members, have expensive hobbies, or want to save aggressively for retirement. Buying well below your maximum approval amount is almost always the smarter long-term decision.
All right, let's get into part one, the core math, the 28-36 rule and debt to income.
To keep you from becoming what they call house poor, we first need to clarify a really vital difference, and that's gross income versus net income. Now, your gross income is that big, pretty number before any taxes are taken out, and it's exactly what the lender uses. But your net income, that's your actual take-home pay. It's the money that actually hits your bank account to pay your real bills. Mixing these two up when you're planning your personal budget is pretty much a recipe for disaster.
And that brings us to the famous 28-36 rule. This is a classic financial guideline designed specifically to keep you from borrowing way too much. So, step by step, here's how it works. Rule 1 is pretty simple. Spend no more than 28% of your gross monthly income on your housing expenses. And remember, housing expenses isn't just paying down the mortgage principal and the interest. It also includes property taxes, your homeowner's insurance, and sometimes even HOA fees. All of that needs to be baked right into that single 28% slice.
Now, Rule 2 expands the picture a bit. Your total combined debts should not exceed 36% of your gross income. So this 36% slice includes those new housing expenses we just talked about, plus literally all your other existing obligations. We're talking car loans, student loans, credit card minimums, personal loans, the whole shebang. Keeping your total debt footprint strictly under this 36% threshold is exactly what leaves you enough breathing room for everyday living, building your savings, and handling life's unexpected emergencies.
That 36% total debt threshold brings us to a piece of crucial lender jargon you'll hear a lot: debt-to-income ratio, or DTI. I like to think of DTI kind of like a financial backpack. It basically measures how much of your monthly income is weighed down by debt before you even get out of bed in the morning. The formula is super straightforward. You take your total monthly debt payments, divide them by your gross monthly income, and multiply by 100 to get a percentage. This is, without a doubt, one of the most important numbers any lender is going to evaluate.
So let's walk through a quick baseline example just to make this super concrete. Imagine you have a gross monthly income of $6,000. Now let's say you pay $400 for a car loan, $250 for student loans, and maybe $150 towards credit cards. That comes out to $800 in existing monthly debt. If we divide that $800 by your $6,000 income, you're sitting at a DTI of 13.3%. Before buying a house, that is a very healthy, incredibly manageable ratio to have.
And this brilliantly illustrates what happens when we add a house to the mix. Let's say your estimated new mortgage payment is $1,700. Suddenly, your total monthly debt just jumped from $800 up to $2,500. Divide that by your $6,000 gross income, and wow, your new DTI is 41.7%. You are officially in the danger zone. You've totally blown past that 36% guideline, which means a much higher lending risk for the bank and, frankly, massive financial stress for you every single month.
Moving on to part 2, the true cost of borrowing.
So beyond that basic math, there are hidden variables that change everything. They can shift the affordability scale completely without the actual sticker price of the home ever changing a single cent. The first massive variable is your upfront down payment. Let's compare two scenarios on a typical $400,000 home. If you only put 5% down, you're taking out a loan for $380,000. But if you can optimize your savings and put 20% down, your loan drops significantly to $320,000. That larger down payment drastically reduces the size of your loan, which immediately lowers your monthly payments. On top of that, it saves you thousands in lifetime interest, and, depending on the loan, it can entirely eliminate the need to pay for private mortgage insurance, or PMI.
Now, the second big variable is the interest rate, and honestly, this one can be a huge shock to first-time buyers. Imagine you're borrowing $350,000 for 30 years. Even if the sticker price of the home stays exactly the same, borrowing that money at a 7% interest rate compared to a 5% rate drastically increases both your monthly payment and your total cost over the life of the loan. This is exactly why savvy buyers focus on the monthly costs, not just the sticker price. In fact, they often adjust their target home price downward when mortgage rates start rising in the broader economy.
And then, of course, we have the hidden recurring costs: property taxes, homeowners insurance, and HOA fees. First-time buyers forget these all the time. Property taxes fund your local services, and they can vary wildly depending on what city or even literally what street you buy on. Homeowners insurance is required by your lender to protect against risks like fire or severe storms. Both of these are usually held in an escrow account, which basically means the lender collects a piece of them inside your monthly payment. Finally, if you buy into a planned community, those homeowners association fees for things like pools and parks absolutely must be factored in. Ignoring these three items is, without a doubt, the fastest way to shatter your perfectly planned budget.
Okay, part 3. Real-life affordability comparison. Let's look at this in action.
Now, what's really interesting about this slide is seeing how two people with the exact same salary can have completely different financial realities. Both buyer A and buyer B earn an identical $90,000 income. And keep in mind, whether you make $50,000 or $250,000, these exact same ratios scale up or down to dictate your reality. So buyer A saved up a 20% down payment, locked in a solid 6% interest rate, and doesn't have a car loan. Buyer B, on the other hand, only put down 5%, got a higher 7% rate, and is still paying $550 a month for their car. Because buyer A optimized their down payment and avoided extra debt, they borrow less, they pay less interest, and they experience far, far less financial pressure every single month. It just goes to show that affordability is about so much more than just your base salary.
All right, wrapping things up with part 4, common mistakes and practical advice.
Let's turn all this theory into practical advice so you can steer clear of classic pitfalls. Here is a fast-paced checklist of the most avoidable mistakes that lead to extreme financial stress for new buyers. Number 1, buying at the maximum loan amount instead of sticking to your personal budget. Number 2, completely forgetting to factor in property taxes and homeowners insurance. Third, ignoring those sneaky HOA fees. Fourth, underestimating the cost of home maintenance and repairs. Remember, when the water heater breaks, the landlord isn't coming to fix it anymore, you are. And finally, and this is a big one, taking on new debt, like financing a whole house full of brand new furniture right before closing. Just avoid these, and I promise you, you are already way ahead of the pack.
So the crucial point is that achieving true long-term stability really comes down to 4 actionable steps. Step 1, always budget for your personal comfort, not the bank's maximum approval. Step 2, strictly apply that 28-36 rule we talked about to keep your housing costs and overall debt perfectly in check. Step 3, really evaluate your debt-to-income ratio before you even apply for a mortgage. And Step 4, always account for those hidden costs like taxes, insurance, and fees.
Before we wrap up, I want to leave you with this final, somewhat provocative thought. Purchasing a home is likely one of the biggest financial decisions you will ever make. But before you go and sign your name on a 30-year mortgage, you really need to ask yourself, what are your true financial goals? Do you want to travel the world? Retire early? Maybe start a business? Taking the time to deeply understand your true affordability ensures that your new home actually improves your life rather than completely consuming it. If you just take the time to map out your true comfort zone, the right house will feel like home in every sense of the word. Thanks so much for joining me on this explainer, and hey, happy house hunting!